The role and evolution of the Federal Reserve in the United States. Central banking has been a topic of contention throughout the history of the United States. Despite opposition from some of the founding fathers, central banks were eventually established in the country. Over the next few minutes, we will explore the establishment of the Federal Reserve, its original purpose, and how its role has evolved over time. The establishment of the Federal Reserve. In 1913, Congress passed the Federal Reserve Act, which created the Federal Reserve, the central bank of the United States. The original purpose of the Federal Reserve was to address the issue of banking panics. Prior to its establishment, individual banks would fail, resulting in the loss of people's money. The central bank was created to bail out failing banks and stabilize the banking system. The Great Depression and expansion of the Federal Reserve's role. Within 8 years of its establishment, the U.S. experienced the first Great Depression in 1921, followed by the new Great Depression in 1929. These economic crises were a result of the transfer of risk from individual banks to the entire system, destabilizing the banking system. As a response, the role of the Federal Reserve expanded. In the 1940s, the Federal Reserve engaged in yield curve control to help the U.S. government finance its war debt. However, this led to inflation and high interest rates. In 1977, the Federal Reserve Act was amended to include a dual mandate, which consists of promoting maximum employment, stable prices, and moderate long-term interest rates. Tools and mandates of the Federal Reserve. The Federal Reserve uses various tools to achieve its mandates. It can adjust interest rates, specifically the federal funds rate, which influences other interest rates in the economy. It can also manipulate its balance sheet by printing money or withdrawing cash from the system. These actions aim to stimulate employment, control inflation, and maintain moderate interest rates. The purpose behind the mandates. The question arises as to why the Federal Reserve is tasked with these mandates. The answer lies in the benefits it brings to the U.S. government. A fully employed citizenry generates significant tax revenue for the government. Additionally, stable prices, defined as a 2% annual increase, allow the government to collect more taxes on profitable sales. Lastly, moderate long-term interest rates benefit the government by providing cheaper borrowing options. Conclusion. The Federal Reserve was established to stabilize the banking system and address banking panics. Over time, its role expanded to include promoting maximum employment, stable prices, and moderate long-term interest rates. However, these mandates ultimately serve the purpose of providing a constant and growing source of funding for the U.S. government. As long as it continues to serve this function, the Federal Reserve will remain in existence.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.